Hello, everyone.
Flash is on.
What the fuck?
Flash is on.
So loud.
Use darker surface.
Shut the fuck up.
Use darker
Shut the fuck up.
surface. Move closer.
All right, so, oh, Neko, how you doing? We're gonna go over what I'm seeing today, just my analysis, and then I'm gonna take a look at different forex pairs before I start to do anything interesting on the Nasdaq. Where is my journal? Yeah, a little bit for me too. This is what I wrote down. Prices drawn to some form of discount. The large expansion is unsettling, but if I had to look for anything, I want to see a return to the week's range. So, like I'm saying, it's unsettling because we had an expansion yesterday, another expansion to start off today. So it's unlikely we continue to go lower all day. We could probably see some move higher. Um, it's just that it's also likely to just consolidate and chop around. So, you know, it's tough a little bit to trust something, which is why, I'm being careful. But anyways, I have the new day opening gap there. 9:30 might make that Judas swing into that. It looks like it at least. Before I do anything there, though, I want to look at the forex pairs because these don't look bad. We had a bit of consolidation the previous day. I did talk about yesterday how I wanted shorts on Australian dollar and JPY. So JPY did work out pretty well. Yesterday when I was talking about it, it was the high of the day. Australian dollar then made one more high, but anyway, so now this move lower is kind of like a manipulation, I suppose. And London ran it up. So I don't like how London made a huge range. And I don't know. I don't know if I want to do anything with this anymore, just because of the range London did. We've kind of already traded above this. It could be in for retracement, but it's a Friday, so I wouldn't want to really. I mean, I would want to see something like this, but it's a Friday, so I don't know. Uh, Australian dollar. Nothing interesting there. Seems like the dollar seems to be going higher. Yeah, dollars on the delivery higher. Oh, there might have been some lower low. So you see, Australian dollar made a lower high. That's SMT divergence. This is why it's probably a lot more bearish. Yeah. So if I were to look for any short, it would be on the Australian dollar. No, it wasn't a bad short there. 88. Like a nice 4 hour. Anyway, let's done looking at that. Let's keep looking at the NASDAQ. So new day opening gap. Let me get rid of this. So me, I would just kind of let this just play out at this point. I don't really want to try and play a reversal here. What was 8:30 news? Retail sales. Hmm. What I want to do too is listen to that Powell speech yesterday. Or at least look at a review. Oh, look like the Fed are done cutting rates. For now, at least. The recent performance of our economy has been remarkably good, by far the best of any major economy in the world, of course. Economic output grew by more than 3% last year and is expanding at a stout 2.5% rate this year. Growth in consumer spending has remained strong, supported by increase in disposable income and solid household balance sheets. Business investment in equipment and intangible has accelerated over the past year. In contrast, activity in the housing sector has been weak. Improving supply conditions have supported the strong performance of the economy. The labor forces have expanded rapidly and productivity has grown faster over the past 5 years than its pace in the 2 decades before the pandemic. This is interesting here. The labor force has expanded rapidly. Productivity has grown faster over the past 5 years and its 2 decades before the pandemic. Because remember, the problem before the pandemic was the Federal Reserve had no inflation and maximum employment. So like they had like historically low unemployment. Everyone was employed, but there was no inflation. And so the Federal Reserve had, when they cut rates enough to try and get people to employ more and spend more to push up inflation, and then avoid deflation, they had no more space to cut rates unless they were to go into negative rates. And then COVID happened, and they were able to push up inflation and basically bail out corporations by selling cheap or buying into cheap debt, um, as sort of a special purpose vehicle that the Federal Reserve created, which allowed them to use money that they would print to buy corporate debt. And since it was COVID, it was okay. Normally, you can't do that. Anyways, increasing the productive capacity of the economy and allowing rapid economic growth without overheating. The labor market remains in solid condition, having cooled off from the significantly overheated conditions of a couple years ago, and is now, by many metrics, back to normal levels that are consistent with our employment mandate. The number of job openings is now just slightly above the number of unemployed Americans seeking work. The rate at which workers quit their jobs is below the pre-pandemic pace. After touching historic highs 2 years ago, wages are still increasing, but at a more sustainable pace. Hiring has slowed from earlier this year. The most recent jobs report for October reflected significant effects from hurricanes and labor strikes, making it difficult to get a clear signal. Finally, the unemployment rate is notably higher than a year ago, but has flattened out in recent months and remains historically low. Inflation labor market has cooled to the point where it is no longer a source of significant inflationary pressures. This cooling and the substantial improvement of broader supply conditions have brought inflation down significantly over the past 2 years from a mid-2022 peak above 7%. Progress on inflation has been broad-based. Estimates based on the Consumer Price Index and other data released this week indicate that total PCE rose 2.3% over the 12 months ending in October, and that excluding the volatile food and energy categories, core PCE rose 2.8%. Core measures of goods and service inflation, excluding housing, fell rapidly over the past 2 years and have returned to rates closer to those consistent with our goals. We expect that these rates will continue to fluctuate in their recent changes. We are watching carefully to be sure what they do. However, just as we are closely tracking the gradual declining housing services inflation, which has yet to fully normalize, inflation is running a much closer to our 2% longer run goal, but is not there yet. We are committed to finishing job with the labor market conditions in rough balance and inflation expectations well anchored. I expect inflation to continue to come down towards our 2% objective, albeit sometimes bumpy path. So everything's a little rough on inflation, but overall it's working out. It's coming down to the goal. Monetary policy. This is the good stuff. Given progress towards our inflation goal and the cooling of labor market conditions, last week my Federal Open Market Committee colleagues and I took another step in reducing the degree of policy restraint by lowering our policy interest rate to a quarter percentage point. We are confident that with an appropriate recalibration of our policy stance, strength in the economy and the labor market can be maintained, with inflation moving sustainably down to 2%. So I think this is the recalibration of policy stance. This is basically them saying that they're not really looking to cut rates or at the same pace. So they may see less rate cuts, but still rate cuts, but maybe less. As of now, at least, it's not really clear, um, but it does seem like they are not really saying that they need to cut necessarily. We see the risks to achieving our employment and inflation goals as being roughly in balance, and we are attentive to the risks of both sides. We know that reducing policy restraint too quickly could lead to hinder progress on inflation, and the reason why that could happen if they lower rates too quickly is that the neutral rate is, let's say, here at like 3%. This is the rate which, if you are above this, you're restrictive. If you're below this rate, the monetary policy is stimulative. Yeah, so there's a neutral rate and then there's the actual rate, which is what we know what the Fed says it is, what they set. So the Fed decides what the actual, the Fed funds rate is, but there's a hidden rate, which is the neutral rate. And this neutral rate is the rate at which the economy is it's neutral, equilibrium. It's neither growing or shrinking. So when you're above this rate, you're shrinking the economy, right? You're restrictive on monetary policy. And so the Federal Reserve are restrictive right now. The thing is, because if you look at the bond yields, we saw the higher prices on the bonds. Or we saw the higher prices on the bonds, which, if you look at the yields, the yields had fell. No way, they had went up, but they had started to fall. So the and the mortgage rates had also started to fall. I don't know if you can see that. Now you see they're back up to their levels. So they're yeah, they had started to fall from October last year. And so the Federal Reserve, because these yields started to fall, the neutral rate started to fall. So if the Federal Reserve stayed at 5.5, they would have been increasing the restriction on the economy, which would have made things worse. They didn't need to increase the restriction. That's why they didn't raise the rates. And so they lowered the rates, maintaining the gap between the neutral rate and where the fund rate is. But now that you see that the yields are starting to rise, if anything, they're going to need to increase the rate to maintain the same restriction, right? Because the reason why they want to maintain that restriction, that space, is because if there's a crisis, like something, COVID, or I don't know, some sort of crisis, and they need to cut rates in order to respond to the crisis, they want to be able to do so, and they're not going to want to give up that gap that they've worked up between the neutral rates and the rates. Because before COVID, when there was historically low unemployment and there was low inflation and they had almost 0% rates, the gap between the neutral rate and the actual rates were like nothing, right? So they would have needed to put the rates to negative underneath the neutral rate in order to stimulate the economy. But now that they've had COVID and they've built up a space between neutral rate and actual Fed funds rate, that that space now reducing monetary policy faster than the rate at which the neutral rate is dropping. A neutral rate is not something you can just find. You have to calculate it. It's very complicated. But you can. People right now assume that it's at 3.3%, 3.5%. Economists at least, and the Federal Reserve believe that's where it's at too. But that space between the Fed funds rate, which is currently at 4.75%, to the neutral rate, which is probably around 3%, that space is what is allowing the Federal Reserve to respond to a crisis when they cut their rates and shorten that gap between the two. So they don't want to shorten it yet because there's no reason to. Why would they give up progress that they made on monetary policy, regaining ammunition back in order to respond to a crisis when they have absolutely no reason to do so, right? So that's the thing with the Federal Reserve and their monetary policy, and why when they say that if they reduce it too fast, it's bad because there's no need to reduce it too fast. And when we see the yields go up, the mortgage yields like I just showed and the bond yields when I just showed, when you see them go up, then you know that if anything, the neutral rate is going to be going up. And so the Federal Reserve, if neutral rate is going up, that space between the rates and neutral rate is shrinking. Federal Reserve is just going to want to increase the rates, if anything, the way I see it. So, I mean, as long as these yields keep going up, mortgage keep going up, the Federal Reserve probably won't move. They probably won't do anything. And if too, you can get the I know it's when you go beneath the neutral rate, you become stimulative. If they can get the neutral rate closer to where their current rate is at, and the gap can be smaller but higher in rates, then they are allowed to drop the rates to even 0% and still have the neutral rate higher, which is incredibly stimulative. So if anything, I think that's probably what they would try and do. But I mean, I don't know. That's just my opinion. So, anyways, I see something might work. I would not take it just because there hasn't really been a clear sweep. And there's 10 o'clock news, business inventories. Because it kind of does look like a market shift, but there's a 5-minute gap here that prices ran into, so I wouldn't trust it if I look at it from this perspective. Yeah, let me keep going with what I was reading. So at the same time, reducing policy restraint too slowly could unduly weaken economic activity and employment. And the reason why that's the case is obviously because if you don't lower the rates and the yields keep falling, the mortgage rates keep falling, the yields keep falling on the bonds, and then you're increasing restriction unnecessarily when you don't need to. And because there's no COVID, there's no money being printed and stimulating effects like stimulative paychecks, whatever that people are getting. and tax cuts for businesses, that would actually be bad and would result in a sort of like a stagflation. Like, if you keep the rates unnecessarily high for too long, then you're gonna have something like you had in the 80s. Um, okay. Anyways, moving on. Two more paragraphs. We are moving policy over time to a more neutral setting, but the path for getting there is not preset. In considering additional adjustments to the target range for the federal funds rate, we will carefully assess incoming data, the evolving outlook, and the balance of risks. The economy is not sending any signals that we need to be in a hurry to lower rates. The strength we are currently seeing in the economy gives us the ability to approach our decisions carefully. Ultimately, the path of policy rate will depend on how the incoming data and the economic outlook evolve. We remain resolute in our commitment to the dual mandate given to us by Congress: maximum unemployment and price stability. Our aim has to be to return inflation to our objective without the kind of painful rise in unemployment that has been accompanied by past efforts to bring down high inflation. That would be a highly desirable result for the communities, families, businesses we serve. While the task is not complete, we have made a good deal of progress toward that outcome. Thank you, and I look forward to our discussion. And then it was question period after that. So that speech was yesterday afternoon, and obviously it's so it kind of, I guess, gives you an idea of where the Fed is at with things. And then this week we had CPI and PCE, which is pretty big, so we had quite a bit of volatility afterwards. But inflation rate did, don't look at month to month, year over year, did increase. So it's been dropping previously, and now it's starting to increase. And so it kind of shows you that the Federal Reserve don't need to cut rates. If anything, they need to raise the rates, right? So keep that in mind. I guess. But I wonder, was anyone listening to that? Did anyone listen to that whole thing, or did I talk? I didn't talk for no reason because I was reading the speech anyway. But okay, nice, nice, Neko. At least someone heard. I wouldn't have cared if no one listened to that, but that was a lot of talking. Wait, let me see that. Anyway, I could have left you looking like a schizo. That's funny. Yeah, see, could it be inversed? JD Astra, I do not know who that is. Let me check. It's a sci-fi fantasy lit RPG and cultivation novels. Would they make books? Oh wait, no, that's a trader too. There's a trader called JD Astra. Probably who you're talking about. Okay, wait, I like this 5-minute sweep. I went long with micros. Just a test. JD Astra. What about him, Neko? No, I don't know who he is. I'm not on Twitter or like any social medias really. Um, like I don't really know many traders. I know like the big ones, popular ones. I don't know if he's big to be honest. Well, he only has 154. Hmm. Bonds manipulation 814 to 838. Interesting. He's a trader on crack. Hmm. I don't know him. Tell me about like his time-based theories. I saw he had like bond manipulation. I guess I understand the raid 923, 945. That's like days quarterly theory. Hmm. There's a really weird one here. Yeah. I tried to go long at the sweep that low, and then had a 15-point stop. My stop was like right beneath these lows. It was just hovering above it, and I got stopped up. Took it with micros though. It's not really a trade that I took on my main account, like the one I'm trading contract on. All right. Yeah, I looked into some stuff he created. It's really interesting. Jake Paul and Tyson fight today. Yeah, I think Jake Paul's gonna win. And Tyson, I don't know. I don't know boxing, but he's 58. I don't care if you think he's a goat or not. I might try and long again. Might have had too tight of a stop. I don't know. I want to see an inverse. I don't know. I don't know if it's gonna work. It's one of those days. Well, tried the long here, didn't work. Then a long that order block didn't work. So yeah, that's all. I only lost that much, so it's fine. And probably done for the day. Unless like if we get like 1 minute, a nice 1 minute gap that inverses, but we need another 5 minute short term low. I think we're too far from the current one. I might try and take one of the contract. Otherwise, no, nothing. Nice city Collins, actually. Yeah. No, I mean, what the heck? It is not. I would have inversed this. I just didn't think of it. And by the time I thought of it, it was down here. I would have inversed it with a micro. It wouldn't have been my model, but I wouldn't have, I probably would not have inversed from up here. That would have been scary. And now it's just too far down to actually trust anything. You know, like anything, it'll consolidate or continue going. So I'm not doing anything for the rest of the day. About to go to work. That's what I'm gonna do. You know, fuck. I wish I could play Tarkov. To be honest, instead of this morning, I'm working at the pizza place. The thing with Tarkov is I have to like plug in my computer. I might have I might play and just have time for one game. I'm thinking of it. I don't know. Yeah, it's not worth it. I look Italian enough. Okay, hold on. You were in Germany, right? So I was talking to somebody the other day about moving to different places. I'm always talking about moving, but I will one day. And I was saying like Europe, somewhere in Europe, and he was saying if you have an American passport and you go to like France, you can get kidnapped by radical Muslims. And I asked about Germany, and he said, no, Germany you're fine. There are not many Muslims there. Poland is good. And then I said Italy, and the guy said that Italian, they're like mafia and stuff. Scary people, don't trust them. Like what? I mean, definitely not fine. So if I go to Germany and I have an American passport, which I don't have one, but will I get kidnapped? Yeah, why would I get kidnapped? I've never heard anyone say that. Oh, by the way, you might get kidnapped. Okay, I don't know. I think Italy would be a great place to live, but apparently there's mafia there. Hmm. I learn something every day. So, it's a nice time to buy gold. Well, I'm probably gonna do schoolwork because there's not really much to look at for the price. But I guess that's it for the stream. Oh, unless anything else needs to be said, then because price is just going lower. I mean, it's gonna be like that all day. And then the bonds, not the bonds, the forex have already kind of reached their draw on liquidity. I'm not really interested in anything else. Gold is in a really good spot to buy. I'm not gonna lie. I think usually I find that in every down move, like correction where you buy, the stocks are usually the last one to do it. Like July. Except for gold now. Gold was probably still, yeah. Gold is probably still going up. I mean, I don't know. Where's July? Bonds went, oh yeah. Wait, stock market crashed while everything went up. Oh yeah, it's because of the yen. Well, anyways, yeah, I'll see you next week. Have a good weekend.